HDFC AMC will be listing on the exchanges today. Now, the company had seen some strong subscription numbers, and on the back of this, the street is expecting a premium of close to 580 rupees per share. That is a listing gain of close to 53%. So let's see how the valuation would stack up on listing. Now, at the issue price of 1100 rupees, the market capitalization of the company was close to 23,300 crore rupees. FY18 price to earnings was 32 times. FY18 price to book was close to 10.8 times, and market cap as a percentage of FY18 asset under management was close to 7.8 times. Now, if it lists at a premium when the share prices are close to 1500 rupees, then the market capitalization of the company would be close to 32,000 crore rupees. Price to earnings would be 44 times, price to book would be 14.7 times, and market cap as a percentage of AUM would be close to 10.7 times. Now, if the share prices are close to 1600 rupees, then the market capitalization of the company would be close to 34,000 crore rupees. Price to earnings would be 47 times, price to book would be 15.7 times, and market cap as a percentage of AUM would cross 11 times for the FY18 AUM. Now, this is what the valuations would look like on listing, but would it be right for the investors to buy the share prices, to buy the stock if the share price is soared to such a high level? Let's see what experts have to say on this. Now, Deven Choksi is comfortable with the valuations of HDFC AMC if the share prices are close to 1540, that is a premium of 40% to the issue price. Vaibhav Chaudhary would advise investors to buy the stock if the share prices are not above 1250, because if it goes above that, then the valuations would be too demanding according to him, while Siddharth Khemka of Motilal Oswal believes that he would invest in the share price in the stock if the share prices are close to 1450, and given the grey market premium, the prices are expected to be above these levels. Now, we all know what HDFC AMC does, but two charts that show why the company has gained so much traction. Now, the company has total 133 schemes, of which 27 are equity oriented while 98 are debt. Now, this is the important part. 47% of its mutual fund AUM has been into equity funds, and this has been increasing for the company over the past years. Now, a rising contribution from equity funds means that the company's total expense ratio allowed is increased, and that works in favor of an asset management company. Now, second is the chart which shows the number of SIPs and the average size of SIPs. Now, the total number of SIPs for HDFC AMC has increased from 19.8 million in FY16 to close to 30 million as of FY18, and the average size has increased from 3,000 rupees to 3,900 rupees. This shows how HDFC AMC schemes are gaining traction among investors. Now, in financial comparison, we have compared it with Reliance Nippon, which is the only listed asset management company in India, and we have also compared it with the ICICI AMC, which is the largest asset management company in India. Now, HDFC AMC's revenue, net profit and asset under management over FY14 to FY18 have grown at a better rate when compared to Reliance Nippon, but have grown at a slower rate when compared to ICICI AMC's. Now, the company's revenue, net profit and AUM grew at a CAGR of around 20%, 19% and 27.5% over FY14 to FY18. Now, though these growth rates are lower when compared to ICICI AMC's, but it is still the most profitable asset management company in India. The company's net profit as a percentage of AUM is the highest in the industry because of its higher revenue and comparatively lower total expense. Now, for FY18, the company's revenue, net profit and total expense as a percentage of AUM stood at 0.59%, 0.24% and 0.27%. However, compared to FY14, all the three unit metrics for HDFC AMC have declined. Lastly, on the return ratio side, the company's return on equity and return on asset are better than Reliance AMC, but are comparatively lower at a lower side when you compare it with ICICI AMC. Also, compared to FY17, the company's return on equity has declined to 33.4%, while the return on asset has remained stable at close to 36.4%.